Before we start, I want you to hit that red subscribe button so that you never miss out on any of our videos. And also smash that like button. Thanks. Hey guys, what's up? Welcome back to The Impeccable Investor. As the world has entered this phase of uncertainty and chaos because of the coronavirus, earning money has become hard. Real estate investment trust, REIT, is a very effective choice for investors to invest money and expect a good return. REIT basically enables investors to buy shares in a commercial real estate portfolios. Generating higher income with dividend yields can be done easily through investing in REITs, as they have a lower correlation with the stock market compared to common stocks and also have modest sensitivity to treasury bond yields compared to many fixed income alternatives. Here we will talk about the 5 best REITs that you can buy in 2020. Digital Realty Trust, DLR. With a 3.4% dividend yield for 2020, Digital Realty Trust makes place in this list. As a data center real estate investment trust, DLR, keeping the current global situation in mind, has been taking steps to provide a sustainable platform to investors, where environment-conscious investment is a hot topic in Wall Street. DLR has assured investors that they will be using renewable wind power in Dallas. By doubling their renewable energy sourcing, DLR has attracted numerous environmentally conscious investors into buying shares for a sustainable future. Moreover, they are also capable of remote operation, which would not require any physical interaction. This has enabled stockholders to have an attractive dividend yield in these uncertain times. The stock is expected to increase in the coming time, giving hope to investors for a sustainable future. Prologus, PLD. Prologus Inc. is a REIT that invests in logistics facilities and real estate. Unexpected, however fruitful for PLD, coronavirus has sparked growth in the category of e-commerce, home improvement, and grocery. Prologus has ended this primary quarter with $3.8 billion in credit line availability and $800 million in cash. The company's debt-to-market capitalization ratio was 22%, including the company's co-investment ventures of $3.1 billion in open-ended funds, more than $10 billion in investment capacity. This can benefit PLD in the logistics real estate sector. REITs like these can often be insulated in recessions due to long-term nature of the leases they sign with customers. Their CFO assured investors, "We entered the COVID-19 crisis in a position of financial strength. We have significant liquidity as well as investment capacity, and our dividend is well covered." Moreover, PLD is a safe choice for investors to earn dividends. American Tower Corp, AMT. As a wireless and broadcasting corporation, American Tower Corporation has an advantage over many REITs. As they deal in the wireless sector, their demand in the market is likely to remain the same regardless of how the economy is performing. Since customers require their services, they are likely to stay in business, as people are homebound and cannot meet their loved ones. Wireless communication is playing an important role in connecting people. This is where American Tower gets the edge over other REITs, as it is one of the largest REITs in the world. As the top of the December end quarter, the corporate had $4.4 billion of total liquidity. This comprised $1.5 billion in cash and cash equivalents and availability of $2.9 billion under its open-end credit facilities. If you want to invest in a REIT that will be safe and advantageous for you, AMT is the right choice. Medical Properties Trust Inc., MPW. Medical Properties Inc. is a healthcare REIT that owns hospitals. It is one of the most unique options in this list. Their performance in 2019 was commendable, where it gained over 39% of returns. Recently, MPW gave their shareholders with a 50% return of their investments. Moreover, MPW offers above-average dividends, which is expected to increase in the future. MPW should be able to continue producing strong total returns, which is why the upside potential makes them great REITs to buy right now. Essential Properties Realty Trust, EPRT. Rated as an overweight stock by analysts, Essential Properties Realty Trust is a safe investment option with a reasonable dividend yield. The debt-to-equity ratio for EPRT is 0, which shows that the trust does not rely on borrowing for its long-term debt ratio in 0.61, which indicates that since the ratio is low, EPRT is good at asset management as they require less borrowing to carry out business. When we look at their quarterly performance, we see that their revenue increased rapidly by 37% to $39.2 million as years went by. Net income soared 151% to $14.5 million, which translated earnings per share (EPS) increasing 38% to 18 cents. Essential Properties reaffirmed its previously issued full year 2020 guidance. It expects AFFO, their profitability per share, to be in the range of $1.27 to $1.30. In 2019, this metric was $1.14, so the company's outlook implies growth of 11.4% to 12.3% year over year. The stock is expected to increase in the future by 4.76%. This is why you should opt for EPRT if you want to invest your money. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.